G'day everyone, welcome back to Pete's Investing. Today is May 11, 2023. This is the spot gold price update. So what we have here is three charts. We look at the weekly for our major trend indicator. On the daily we look at key support resistance areas, and on the hourly we trade. And when I say the hourly, you can trade any lower time frame that suits you, 15 minutes, 2 hours, 4 hours, whatever suits you. But that's our trade area based on the weekly and daily trends. Let's look at each of these in detail. And for those new to the channel, what I look at here is look at the triple moving average of the price chart, and that's moving average 3, 5 and 60 versus the CCI 150 moving average 5 and 50. When they're aligned like they are now on the weekly for gold, it's showing a bullish momentum, which is this indicator which combines both. When it's bearish like it was in this period, it shows bearish, predominantly short trades or bearish trades. And where it's flat, like in that period, it means both or one of the two indicators on the price or the CCI are not aligned. So avoid going long or short. So at the moment, we're predominantly long trades. On the daily, at the moment, you'll notice it's neutral. So probably I prefer to make sure they're both aligned, the weekly and the daily. So in this case, I wouldn't be trading until the daily as well shows a bullish momentum to align with the weekly. But what we've got here as well is, if I zoom out, you can see here there's a key support area at 1617, resistance at 2082. Now, I've also drawn this Fibonacci from that low to that high. You can see there the price fell back and sort of bounced along the 38% for some time. But I've also got these diagonal trend lines, both ascending and descending. It did initially cause this wedge, but it broke out of that wedge to the upside. But now it's still potentially bouncing along that ascending line. But notice it bounced off that key resistance, so that'll be a major hurdle to be more positive about going long. Now, one thing to notice, I've also drawn this on the CCI is a bearish divergence versus a bullish divergence on the price chart, and these don't always play out, but when they do, they work out quite nicely. This is basically telling us potentially the price is going to collapse. Now, for this to work, we need to see the price collapse below this ascending trend line. Likewise, the CCI will also fall to the downside. For this to fail, in other words, if the price kept going up and broke through this resistance and further to the upside, then we should also see the CCI break to the upside as well, which means this divergence failed. So just be mindful of that as we move forward in terms of taking long or short trades. On the hourly, again, this is where we take predominantly our trades based on their daily and weekly trends. As a trading idea, I'll use the fractal breakout. So if I put in the fractals there, for example, let's assuming both daily and weekly were aligned at long positioning, we would take long positions when they break above the fractal there. So, and avoid obviously going short when the weekly and daily trends are going long, and vice versa. What I've also got up here is a back test, which shows the results of running the test since September 21. Now, one thing I want you to understand is each of these is a single entry and exit of a trade. Where it shows steps like this, it means there's multiple contracts entered during the average down process. We don't take stop losses, we use the average down. Now you might say, well, hang on, I'm going to take a bit of a hit with this is a profitability chart up here. I'm going to take a bit of a hit with my profitability if I let this run throughout the whole period. What I'm advising you to do in terms of trading, as a trading idea, I'm not telling you to buy this or sell this, I'm just telling you as a trading idea, make sure that both the weekly and the daily are in alignment before taking those trades. So if I move the cursor there during that period, you'll notice, one second, you'll notice at that point, that would have been the last point on the weekly where you would have gone long. So you may have entered one lot of contracts, and you'd be one contract down and not 1, 2, 3, 4, 5 contracts down. So you would still be in the red, possibly, if you took that trade based on that weekly. But again, that's why I say always trade with the weekly and the daily being in alignment. Let's look at the daily. Actually, no, you wouldn't have taken that trade, because if you see the weekly there, that shows a long position. And on the daily, if you look at that thin grey bar on the daily chart, the middle chart, there is no long positioning on there. So there's no long positioning there. So you would not have entered that trade. In other words, you only go long when the weekly is in alignment with the daily. So you would have taken very minimal trades, not this whole period. And again, this back test runs the whole period. So to understand how to run this and other trading ideas using the average down approach, reference the links in the description below to access my Patreon page. With weekly stock scans, we average down strategies. We include stocks, currencies and commodities. Subscribe, like and share the channel. Thanks for watching and see you in a future video.